Good morning and welcome to TOITOI Japan Market Radio. I'm your host coming to you from Tokyo on this Sunday, November 30th, 2025. For those of you tuning in, this show is designed for global investors who are tracking Japan exposure or considering allocations to Japanese equities, fixed income, or currency. Today we have a bit of a unique setup. Japan's markets were actually closed for a holiday, so we'll be focusing on some broader developments that matter for your Japan positioning.
Thanks for having me. You're absolutely right. No trading action today in Tokyo, which means we don't have fresh Nikkei or TOPIX prints to dissect. But that actually gives us a good opportunity to step back and look at some macro themes and external catalysts that are shaping sentiment heading into the final month of the year. We've got some interesting cross-currents: oil supply dynamics out of OPEC+, Eurozone inflation data that's influencing ECB policy expectations, and a retrospective look at Japan's equity performance over the past several years that's getting some attention. All of these have implications for how we think about Japanese risk assets, the yen, and rates going forward.
Let's dive into the first item, which is coming out of the energy space. Reuters is reporting that OPEC+ is set to hold its oil output policy steady, with sources indicating no major adjustments to production levels at this stage. For a country like Japan that imports nearly all of its crude, this feels like it should be on investors' radar. Walk us through why this matters.
Absolutely. Japan is the world's third largest economy and one of the most energy import-dependent developed markets. So any decision by OPEC+ on output has direct read-throughs to inflation expectations, corporate cost structures, and even consumer confidence. When OPEC+ holds output steady, it signals that they're not trying to squeeze supply or flood the market. Basically, they're aiming for price stability. For Japan, that removes a tail risk. If oil prices were to spike, you'd see margin pressure across energy-intensive sectors like chemicals, utilities, and transport, and you'd also see a potential uptick in headline inflation that could complicate the Bank of Japan's normalization path.
So in terms of market impact, how should we be thinking about equities, the yen, and yields?
On equities, this is modestly positive. Stable oil supply supports the profit outlook for industrials and the big trading houses that are very sensitive to commodity price swings. It also keeps inflation expectations anchored, which means the BOJ has less pressure to accelerate rate hikes. That's supportive for valuations. On the yen side, the impact is more indirect. Stable oil prices reduce the risk of an external inflation shock, which in turn reduces the urgency for the BOJ to tighten aggressively. That could keep the yen from strengthening too sharply in the near term, especially if risk appetite stays firm. And for JGB yields, this reinforces the case for the BOJ to stay cautious. No new energy-driven inflation impulse means they can afford to move slowly, which should keep yields from climbing too fast.
That makes sense. So it's not a game changer, but it removes downside risk and supports the status quo.
Exactly. It's a neutral to slightly positive backdrop, but not something that's going to drive a major re-rating on its own.
Shifting gears now, we've also seen some renewed attention on Japan's equity market performance over the medium term. Statista has published a detailed look at the Nikkei 225's monthly development from 2019 through 2025. This isn't breaking news per se, but it's a useful retrospective. What's the takeaway here for someone managing a Japan allocation?
This is more of an informational piece than a market-moving catalyst, but it's worth pausing on because the 2019 to 2025 window captures a lot of pivotal moments. You've got the pre-pandemic environment, the COVID crash in early 2020, the subsequent recovery fueled by global liquidity, the BOJ's persistent accommodation, and then more recently the yen's weakness, which has been a tailwind for exporters and helped push the Nikkei to multi-decade highs. What this kind of historical aggregation does is remind investors that Japan's equity market has been surprisingly resilient and, in fact, has outperformed many expectations over this period.
And does that historical strength influence current sentiment, or is it really just backward-looking?
It's mostly backward-looking, but it can reinforce narratives. If you're a global allocator and you see that Japan has delivered solid returns through a period of significant macro turbulence, that can support the case for maintaining or adding exposure. It also highlights the importance of structural factors, corporate governance improvements, shareholder return mandates, and the yen's role as a valuation lever. So while this article itself won't move markets, it's part of a broader story that's helping Japan regain credibility among international investors.
Fair point. On the policy side now, we're also watching developments out of Europe that have some read-through for global monetary policy coordination. Bloomberg is reporting that Eurozone inflation is nearing the ECB's 2% target, and that's expected to seal the deal on the European Central Bank holding rates steady rather than cutting further. How does that connect to Japan?
This is actually quite important for Japan, even though it's happening in Europe. The key issue here is policy divergence. The ECB pausing its easing cycle while the BOJ is still in the early stages of normalization means the interest rate differential between the Eurozone and Japan could widen over the coming quarters. That has implications for capital flows and currency dynamics. If European rates stay elevated relative to Japan, it could put downward pressure on the yen, especially if risk appetite remains strong and investors continue to favor carry trades.
So we could see more yen weakness as a result?
Potentially, yes. The yen has been used as a funding currency for years, and if the ECB is signaling that rates are going to stay higher for longer while the BOJ moves very cautiously, that gap becomes attractive again. Now, there are countervailing forces. If global growth slows or risk sentiment deteriorates, you could see a sharp yen rally as carry trades unwind. But in a stable or risk-on environment, this ECB decision is modestly yen negative.
And what about Japanese equities in this scenario?
For equities, it's actually a mild positive. A stabilizing Eurozone suggests that one of Japan's key export markets is not falling into recession, which supports the earnings outlook for Japanese industrials and automakers. It also reduces the risk of a global deflationary shock, which is important for sentiment. And if the yen stays weaker as a result of this policy divergence, that's a tailwind for the export-heavy Nikkei 225. So net-net, this is supportive for Japanese stocks in the near term.
And on the fixed income side, does this change the outlook for JGBs or BOJ policy expectations?
The direct impact is limited, but there's a subtle signal here. If the Eurozone is stabilizing and inflation is under control without the need for aggressive easing, it suggests that the global disinflationary impulse may be moderating. That gives the BOJ a bit more room to normalize without worrying about being the only major central bank tightening into a weakening global economy. So it's marginally supportive of the BOJ's gradual normalization path, but it's not going to force their hand in the near term. JGB yields are likely to stay range-bound unless we get a major shift in domestic inflation or wage data.
So pulling all of this together, we've got a holiday in Japan but plenty of external factors to watch. OPEC Plus holding output steady removes an energy price tail risk, historical Nikkei data reinforces the narrative of Japan's equity resilience, and the ECB's likely rate hold signals policy divergence that could weigh on the yen but support Japanese equities. How should global investors be thinking about Japan positioning as we head into December?
I think the key message is that Japan remains a story of gradual normalization, both in terms of monetary policy and in terms of market sentiment. The BOJ is moving very carefully, and that's appropriate given the domestic growth backdrop and the external uncertainties. For equity investors, the combination of stable oil prices, a weaker yen, and improving corporate governance continues to support the bull case, especially in export-oriented sectors. On the currency side, we could see more volatility, particularly if policy divergence with Europe and the US continues to widen. And for fixed income investors, JGBs are likely to remain anchored by the BOJ's cautious approach. But there's upside risk to yields if domestic inflation surprises to the upside or if the BOJ signals a faster pace of normalization.
That's a really helpful framework. And as always, we're not here to tell you what to buy or sell, just to give you the context and the data points that matter for your Japan exposure. If you're a global investor tracking Japanese markets, we'd love to have you subscribe to TOITOI Japan Market Radio. We'll be back with more analysis as markets reopen and we get fresh data. Thanks for joining us today.
Thanks for having me. Looking forward to the next one.